For nearly 20 years, Canada and Australia were held up as models of stability and prosperity in global real estate. Their housing markets attracted billions from overseas, backed by strong legal systems, steady economies, and the promise of reliable returns. But something fundamental has changed. Today, institutional investors, wealthy individuals, and even everyday homeowners are quietly moving their money out of these once safe markets and redirecting it toward the United States, certain you. This shift isn't driven by panic, nor is it a short-term reaction to market volatility. It reflects a deep recalibration of risk, return potential, and long-term sustainability. The outflow of capital from Canada and Australia is rooted in structural weaknesses that have developed over many years and are now reaching a breaking point. Canada and Australia now rank among the least affordable housing markets in the world. Vancouver, Toronto, Sydney, and Melbourne frequently appear in global lists of the most stretched price-to-income ratios. In Toronto, the average home costs roughly 14 times the median household income. Sydney's ratios are similarly extreme, with some suburbs far exceeding those levels. Why does this matter? Because housing markets function properly only when prices remain connected to what local residents can afford. When that relationship collapses, prices become propped up by foreign capital, speculative demand, and excessive debt, rather than actual economic fundamentals. This disconnect has created a generation of high-income professionals, doctors, software engineers, architects, lawyers, who cannot realistically buy homes in the cities where they work. Home ownership has drifted out of reach not only for young people, but also for middle-aged workers earning strong salaries. For investors, this is a red flag. Markets priced far beyond local incomes are inherently unstable. They depend on constant inflows of new, often speculative capital. Any slowdown in immigration, credit availability, or investor optimism can trigger price stagnation, or worse, price corrections. Sophisticated investors see the asymmetry clearly: minimal upside, substantial downside. The debt trap: households. Near the breaking point, Canada and Australia now rank among the world's most indebted nations relative to income. Canadian household debt sits at more than 180% of income. Australia's is slightly higher, at 185%. Most of this debt is tied to mortgages, but unlike the US, which widely offers 30-year fixed mortgages, Canadian loans typically reset every 5 years. In Australia, variable rate loans dominate, leaving borrowers exposed to rapid interest rate fluctuations. When central banks began aggressively raising rates to fight inflation, the impact hit households almost immediately. Mortgage payments surged by hundreds or thousands of dollars a month. Families who bought homes at peak prices during the low-rate era suddenly found themselves stretched to the point of financial stress. Canada faces a particularly dangerous renewal cliff. Over the next 2 years, hundreds of thousands of mortgages taken out at 1 to 2% interest will renew at rates above 5%. The shock to monthly payments will be severe. Default rates, though still low, are already creeping upward. This level of indebtedness weakens consumer spending, slows economic growth, and introduces systemic fragility into both countries' financial systems. For real estate investors, it signals a market vulnerable to forced selling, reduced rental demand, and unpredictable government intervention. Population growth versus infrastructure failure. Both countries rely heavily on immigration to fuel economic growth and housing demand. Canada has aggressively increased its immigration targets, adding the equivalent of 1% of its population every year. Australia has taken a similar approach. In theory, this supports strong housing demand. In practice, it exposes a major flaw. Neither country has built enough housing or infrastructure to accommodate rapid population growth. Canada would need to double its historical construction pace just to keep up. Australia faces similar supply deficits. The results are visible everywhere: minimal rental vacancies, soaring rents, overcrowded living conditions, families and international students struggling to find basic housing. This crisis reflects decades of restrictive zoning, insufficient construction, and underfunded infrastructure. Cities like Toronto and Sydney are now straining under the weight of inadequate public transit, congested roads, and strained public services. What were once highly livable cities for global talent are becoming less attractive. Government responses, foreign buyer bans, rent caps, speculation taxes, often sound decisive but rarely address the core issue: a chronic shortage of housing and infrastructure. Instead, they create regulatory uncertainty that investors dislike. Yield compression and the global opportunity gap real estate makes sense for investors only when the income it generates, its yield, justifies the capital invested. But in Canada and Australia, rental yields have compressed to historically low levels. In Toronto and Vancouver, gross yields often fall below 3%. Sydney and Melbourne show similar patterns. After expenses, taxes, insurance, maintenance, net yields can become negligible or even negative. This turns real estate into a speculative investment dependent solely on price appreciation. Meanwhile, investors see far more attractive alternatives. US cities offering 5 to 8% yields. European markets offering 4 to 6%, Asian hubs offering strong rents and stable growth. Holding underperforming Canadian or Australian property becomes a poor use of capital when better income-producing assets exist globally. Taxation and regulatory uncertainty. Both countries have increasingly targeted real estate as a political tool. While some taxes serve legitimate purposes, the inconsistent and unpredictable nature of these policies drives investors away. Examples include foreign buyer taxes, vacancy taxes, speculation taxes, stamp duty, surcharges, land tax surcharges. Regulations vary at federal, state, and municipal levels, creating confusion and making long-term investment planning difficult. Even more troubling is discussion around radical proposals like wealth taxes, stricter rent controls, and forced sales of vacant properties. Even if these measures never pass, the fact that they're being seriously debated contributes to capital flight. Investors want predictability, and right now, Canada and Australia aren't offering it. The China factor. A demand engine running out of fuel. There was a time when Chinese buyers were practically the lifeblood of housing markets in Vancouver, Toronto, Sydney, and Melbourne. Their money kept prices rising even when local incomes no longer justified the numbers. But that era is over. China's government has clamped down on capital leaving the country. The once booming Chinese real estate sector is under strict scrutiny, and China's economy is no longer generating the same overflow of wealth. Pile on rising political tensions, and the appetite for overseas homes has collapsed. In Australia, Chinese buyers once accounted for massive slices of new apartment sales. Those days are gone. Canadian markets saw the same story play out. Now, with Chinese capital largely absent, luxury towers and new developments are losing one of their most reliable sources of demand. And nothing suggests this buyer class is coming back anytime soon. Currency risk and capital gains. For global investors, buying property isn't just about price, it's about currency. And the Canadian and Australian dollars have been unpredictable at best. Both currencies have spent years depreciating against the US dollar. That means an investor could buy at the top of the market, watch the property price dip, and then lose even more money when converting back to their home currency. Many are asking, why take that risk? Countries with more stable currencies, like the United States, suddenly look a lot more appealing. The policy response problem. Here's the dilemma. Real estate is politically untouchable. Homeowners make up a huge voting bloc, and most want prices to stay high. That puts governments in a corner. They can't let prices crash, but they also can't solve affordability without a correction. So policymakers do what politicians always do when stuck. They tinker instead of reform. They roll out minor incentives, small tax tweaks, or flashy announcements that don't change the structural reality. Central banks face the same paralysis: raise rates too aggressively and risk a housing collapse, hold back and risk making affordability worse. For investors, this uncertainty is poison. Where the smart money is going. Instead, money always finds a safer home. In this case, it's flowing toward US metros with strong populations, healthy job markets, and better rental yields. Austin, Tampa, Nashville, Phoenix. These cities offer growth stories Canada and Australia can't match right now. Europe is also catching investor attention, especially cities with reasonable prices and strong rental markets. Meanwhile, Asia's safe havens, like Singapore and Tokyo, remain attractive to those who want long-term stability. The demographic headwind. The demographic math is simple. Both Canada and Australia are aging. Baby boomers hold most of the housing wealth, and over the coming decades, they will downsize or pass on their homes. That means more supply, possibly just as political pressures slow immigration-driven demand. That's not a recipe for sustained price growth. Climate risk. The silent value killer. Wildfires, floods, water scarcity. Climate risks are becoming impossible to ignore. Australia is battling intensifying bushfires and droughts. Canada faces a growing wildfire and flood crisis. Insurance companies are already sounding the alarm by hiking premiums or walking away from risky areas altogether. Over time, climate exposure will create clear winners and losers in both countries' housing markets. The construction cost spiral. It's never been more expensive to build. Labor shortages, regulatory hoops, and material costs have pushed construction prices to record highs. Toronto and Vancouver are seeing costs north of $500 Canadian per square foot for new condos. Sydney and Melbourne aren't far behind. If new housing is too expensive to build profitably and too expensive for buyers to afford, the supply problem becomes permanent. What this means for different investor types. For pension funds, insurers, and other institutional investors, the conclusion is obvious. These markets no longer provide the predictable income or long-term stability they need. The risk profile has shifted, and capital is migrating to markets that offer stronger cash flow and fewer structural weaknesses. The China factor. A demand engine running out of fuel. There was a time when Chinese buyers were practically the lifeline of housing markets in Vancouver, Toronto, Sydney, and Melbourne. Their capital kept prices climbing, even when local incomes could no longer justify the surge. But that era has ended. The Chinese government has tightened controls on capital leaving the country. China's once booming real estate sector is under heavy scrutiny, and the broader economy is no longer generating excess wealth at the same pace. Add rising geopolitical tensions, and the appetite for overseas property has collapsed. In Australia, Chinese buyers once dominated the pre-sale market for new apartments. Those days have disappeared. Canadian cities have witnessed the same pattern. With Chinese capital now largely absent, luxury developments and new high-rise projects have lost one of their most dependable demand drivers. And nothing indicates that this buyer class will return anytime soon. Currency risk and capital gains. For global investors, property investment is about more than price. It's also about currency dynamics. The Canadian and Australian dollars have become increasingly volatile, and over the past several years have generally depreciated against the US dollar. That means an investor could buy at the peak, watch the property value fall, and then take a second hit when converting back into their home currency. Many are asking a simple question: why take that risk? By comparison, markets with more stable currencies, most notably the United States, suddenly look far more attractive. The policy response problem. Here's the political dilemma. Real estate is untouchable. Homeowners form a massive voting bloc, and most of them want property values to remain high. This puts governments in an impossible position. They can't allow prices to collapse, but they also can't fix affordability without a meaningful correction. So policymakers resort to half measures, small incentives, minor tax adjustments, and headline-friendly announcements that don't address the structural issues. Central banks face a similar paralysis, raise rates too far and risk a housing crash, keep rates low and exacerbate affordability pressures. For investors, this policy uncertainty is toxic. Where the smart money is going instead, capital seeks stability and predictable growth. Today, money is flowing into US metros with strong population growth, booming labor markets, and healthier rental yields. Cities like Austin, Tampa, Nashville, and Phoenix offer growth prospects that Canada and Australia currently can't match. Europe is also capturing new investor interest, particularly cities with reasonable pricing and strong rental returns. Meanwhile, Asia's long-standing safe havens, Singapore and Tokyo, continue to attract capital from investors seeking long-term stability. The demographic headwind. The demographic reality is straightforward. Both Canada and Australia are aging rapidly. Baby boomers hold the bulk of housing wealth, and over the coming decades, they will downsize, sell, or transfer their properties. This will increase supply. Potentially, at the same time, political pressures reduce immigration-driven demand. That is not a formula for sustained price appreciation. Climate risk, the silent value killer. Wildfires, floods, and water scarcity are now unavoidable elements of housing valuation. Australia faces intensifying bushfires and chronic drought. Canada is dealing with escalating wildfire seasons and severe flood events. Insurance companies have already begun pulling back by raising premiums sharply or withdrawing coverage from high-risk regions altogether. Over time, climate exposure will create clear winners and losers across both countries' housing markets. The construction cost spiral building has never been more expensive. Labor shortages, regulatory delays, and soaring material costs have pushed construction prices to unprecedented levels. In Toronto and Vancouver, new condo construction costs now exceed 500 Canadian dollars per square foot. Sydney and Melbourne are not far behind. If new housing is too costly to build profitably and too expensive for buyers to afford, the supply shortage becomes a permanent structural feature. What this means for different investor types. For pension funds, insurance companies, and other institutional investors, the conclusion is clear. These markets no longer offer the stable income, predictable returns, or long-term risk profile they require. The fundamentals have shifted, and capital is reallocating toward markets with stronger cash flow, better economic foundations, and fewer structural vulnerabilities. The banking sector's precarious position. If you really want to understand how fragile the housing markets in Canada and Australia have become, you only need to look at their banks. Instead of being diversified financial giants, they've essentially turned into massive mortgage machines. Banks whose survival depends on one thing: home prices never falling. In Canada, half or more of bank lending is tied to residential mortgages. In Australia, some major banks are even more exposed, with well over 60% of their loan books connected to housing. In almost any other advanced economy, this level of concentration would set off alarm bells. And here's why. When a bank's health depends overwhelmingly on the value of homes, the entire financial system becomes fragile. A meaningful drop in home prices wouldn't just hurt homeowners, it would hit the banks directly. That's why they hesitate to foreclose even when borrowers are clearly struggling. If they foreclose too much, they'd have to admit the losses and could pull the whole market down with them. Instead, they quietly choose extend and pretend, stretching loan terms, rolling missed payments into the mortgage, doing anything possible to avoid saying the loan is actually failing. It's not compassion, it's self-preservation. But this delays reality and keeps zombie loans alive. Loans that will never perform properly, but are kept on life support, so banks don't have to write them off. Over time, this weakens the entire system. And if housing prices do fall in a serious way, banks will slam the brakes on lending. Tighter approvals, lower loan-to-value ratios, fewer mortgages, higher borrowing costs. For international buyers, that means one thing: refinancing will be harder, selling will be harder, and the entire market will feel heavier. Regulators already know how risky this is. That's why they've introduced tougher mortgage stress tests, restrictions on interest-only loans, and tighter debt-to-income limits. But these policies also make buying harder, reducing demand during a time when demand used to be the only thing holding the market up. The rental market paradox. You'd think that if owning a home becomes too expensive, renting would become a goldmine for investors. But the reality isn't that simple. Yes, rents have gone up, sometimes sharply, but house prices have gone up far faster. So instead of improving, yields have actually shrunk. Investors are paying more to buy properties that give them less income in return. And then there's the political reaction. Governments stepped in with rent freezes, rent caps, and stricter tenant protections. Ontario froze rents during COVID and still controls increases tightly. British Columbia keeps annual rent increases on a short leash. Multiple Australian states are introducing or debating similar rules. For renters, it feels like relief. For investors, it feels like getting squeezed from both ends. Costs, insurance, taxes, maintenance keep rising. Income is capped. Margins disappear. On top of that, Airbnb-style rentals have hollowed out parts of the long-term rental market. Governments responded by cracking down, adding yet another regulatory puzzle for landlords to navigate. The result? A polarized rental landscape. Luxury rentals can still charge a premium. Lower-end rentals are heavily regulated. The middle, which used to be the safest, most reliable investment, has become the worst place to be. Large landlords and REITs are figuring this out. Many are quietly shifting toward commercial properties, senior living, student housing, or simply leaving these markets for countries where the rules are more predictable. The infrastructure deficit, a ticking time bomb. Real estate isn't just about the house you buy, it's about the city around it. And this is where the cracks really begin to show. Both countries have grown fast, but their infrastructure hasn't grown with them. Take Toronto. Its transit system is decades behind what a city of its size needs. Subways don't reach enough of the city. Buses are overcrowded. Traffic is a daily nightmare. New transit projects are years delayed and astronomically over budget. Sydney and Melbourne face the same problem. Sprawling suburbs with poor transit connections, endless rush hour congestion, rapid expansion without matching infrastructure. Then there are water issues, especially in Australia. Climate change, droughts, and soaring demand mean cities must rely on extremely expensive desalination plants. No one knows how sustainable this will be in 20 or 30 years. Electricity grids are strained too, transitioning to renewable energy while demand keeps rising. Blackouts and power shortages are no longer rare events. Meanwhile, schools and hospitals are overcrowded. Wait times grow longer. Newcomers and young professionals feel the pressure. For cities trying to attract talent and investment, this is a serious warning sign.